When managing several property projects at once, many U.S. investors look for flexible ways to fund U.S. real estate deals using business credit. Access to structured business credit can help organize cash flow, maintain healthy financial separation, and expand investment capacity responsibly. On Real Estate Capital and Growth USA, this video explores how business credit connects with real estate financing opportunities across America. Before we continue, take a look at the disclaimer. This content is purely educational and aims to explain general concepts. Nothing shared here should be considered financial or legal advice. Let's start by understanding the foundation, what business credit actually is, and why it matters. Understanding business credit basics. Understanding business credit in the U.S. real estate market is crucial for companies seeking organized, scalable, and responsible growth. Business credit represents a firm's financial footprint, its reliability in meeting obligations and handling structured borrowing. For many investors, it acts as a framework that separates professional and personal finances, helping maintain clarity and discipline in cash management. This system supports long-term sustainability across real estate sectors in the United States, from commercial projects in Texas to residential developments in Florida. To understand how this foundation truly operates, let's look deeper into how business credit is built, reported, and perceived by institutions across America. What business credit represents? At its core, business credit is a measurement of trust between a company and financial institutions in the U.S. It records how effectively a business manages payments, handles supplier accounts, and maintains stability through market fluctuations. Unlike personal credit scores, business credit profiles are public to lenders and often influence access to trade lines, lease agreements, and funding for real estate ventures across the USA. This transparency encourages professionalism, ensures that organizations maintain accountability in their transactions. How business credit is built. Building a reliable profile involves consistent payment patterns, balanced credit utilization, and long-term trade relationships. American business credit bureaus, such as Dun & Bradstreet and Equifax Business, compile reports including payment indexes, credit limits, and vendor histories. These elements help illustrate how responsibly a company manages its obligations without crossing into personal credit use. Structured business credit becomes especially relevant for U.S. real estate investors, who often manage multiple property transactions. A disciplined credit record reflects reliability and helps align financial decisions with business objectives. The relevance for U.S. real estate operations. In the competitive landscape of real estate financing in the USA, a well-structured business credit profile enhances professional perception. Developers and property managers with solid business credit often find smoother interactions with lenders and suppliers. However, business credit is not a shortcut to funding. It's an operational discipline that signals organization, foresight, and financial transparency. Understanding these fundamentals allows companies to position themselves responsibly, improving long-term stability in real estate ventures across states such as California, Texas, and Florida. In summary, understanding business credit basics in the U.S. real estate sector equips organizations to operate transparently, maintain consistent growth, and uphold their reputation among partners and financial institutions. The next part of this series will connect these principles directly to practical property financing scenarios throughout the United States. Exploring real estate deals in the U.S. Across the U.S., investors exploring ways to fund U.S. real estate deals using business credit encounter a variety of property types, from single-family rentals to multi-unit apartment complexes and commercial developments. This diversity presents a learning opportunity for understanding how business credit may function as an organizational tool across different project scales. Professionals managing multiple simultaneous deals often coordinate renovations, acquisitions, and rental portfolio growth, requiring structured approaches to track and plan projects efficiently. Let's break down these real estate deal types and examine the dynamics in key U.S. regions. Single-family and multifamily opportunities. Single-family homes often serve as accessible entry points for investment portfolios, offering stable rental income and localized market learning opportunities. Multifamily units provide educational examples of scaling operational management and portfolio diversification. While business credit can help structure financial flows for these projects, this section focuses solely on understanding the operational aspects and market implications in regions like Florida and Texas. Commercial and mixed-use developments. Commercial properties, including retail, office, and mixed-use spaces, represent larger-scale operational structures. In educational terms, analyzing these projects provides insight into how multiple real estate ventures coexist and are coordinated professionally. Understanding demand patterns in urban centers like Miami or Charlotte highlights the difference in project complexity and potential use of business credit for organizational purposes. Regional trends and growth patterns. Data indicates steady demand for rentals in high-growth states like Texas, Florida, and North Carolina, driven by population expansion and economic development. Observing these trends helps investors understand market conditions, illustrating how well-organized business credit management could hypothetically interact with multi-deal projects. Understanding the variety of real estate deals across the U.S. illustrates how responsible project organization may benefit from structured business credit. Observing single-family, multifamily, and commercial opportunities in regions like Texas, Florida, and North Carolina provides an educational framework for studying market diversity. Through regional awareness and professional analysis, investors gain insight into organized funding structures. The role of business credit in real estate. Across the U.S. real estate market, funding multiple property investments using business credit has become a structured way for professionals to maintain stability while managing several projects. Business credit often serves as an operational bridge, helping investors and companies organize short-term project costs, acquisitions, or renovations without relying entirely on personal savings. This structured approach promotes better organization and separation between personal and business finances. To understand how this works in practice, let's look at how business credit actively supports sustainable real estate operations across America. Historically, well-managed business credit has enabled real estate professionals in the U.S. to scale responsibly, whether acquiring multifamily properties or managing long-term rental portfolios. By maintaining a consistent payment record, companies enhance their credibility, opening doors to potential funding opportunities. This relationship between business credit and U.S. real estate investment funding has become an essential part of sustainable property development nationwide. Lenders reviewing business credit in the U.S. often evaluate core metrics like payment history, account age, and overall business profile consistency. These indicators reflect how a company organizes its operations, rather than the owner's personal finances. It's an analytical process that helps maintain transparency between lenders and businesses, fostering professional trust. This transparent structure has contributed to the resilience of many real estate companies across America, especially in states with active investment zones. When applied properly, using business credit for U.S. real estate projects supports liquidity management and financial discipline. It ensures that investment activities remain structured, compliant, and balanced between growth and sustainability. This approach has helped American businesses manage diverse property portfolios while minimizing operational strain. Importantly, this framework should be understood as an organizational tool. The connection between business credit and real estate is not about quick gains, it's about structure, transparency, and organization. Across the U.S., professionals continue to use this framework to sustain project momentum, while maintaining financial clarity. Understanding these mechanisms equips investors with better insights into how organized funding supports the nation's growing property landscape. Next, we'll explore how these structured funding systems are approached across different business credit frameworks and what influences their availability. General funding approaches with business credit. Across the U.S., companies looking to fund multiple real estate deals using business credit often employ structured methods that align operational efficiency with financial organization. Business credit can act as a versatile tool for handling routine expenses, equipment needs, or larger project commitments without relying solely on personal finances. Understanding these methods helps illustrate how businesses maintain flexibility, transparency while managing several property projects nationwide, from commercial developments in Texas to multifamily rentals in Florida. Let's explore the common approaches used to utilize business credit as an organizational framework in American real estate ventures. Revolving credit and operational lines. Some companies rely on revolving credit accounts to manage day-to-day operational costs, including minor property renovations or ongoing maintenance. This approach allows businesses to maintain flexibility in allocating resources while tracking repayment patterns. Used responsibly, revolving credit supports transparency and shows lenders a consistent financial history, which reinforces trust in business operations across U.S. real estate markets. Term-based structures. Term-based business credit arrangements can support larger commitments, such as equipment acquisition or long-term renovation projects. These structured methods provide predictable schedules for repayments and help companies manage multiple real estate properties responsibly. While not a guarantee of results, these approaches are widely used in professional U.S. property operations for their organizational benefits. Factors influencing availability. Access to business credit in the U.S. depends on company-specific factors like age, revenue consistency, and historical credit management. A well-documented, responsible approach to business credit can streamline project coordination for real estate developers, property managers, and investors, ensuring that resources are used efficiently while maintaining clear operational separation. Understanding general funding approaches with business credit demonstrates how U.S. companies organize multiple real estate projects responsibly. These systems, ranging from revolving accounts to term-based structures, highlight organizational discipline and professional transparency rather than promising specific outcomes. Businesses across states such as Florida, Texas, and California benefit from these structured approaches while maintaining operational clarity. U.S.-specific considerations. In the U.S., the ability to fund multiple real estate deals using business credit often depends on understanding regional market differences. Coastal urban centers like New York and San Francisco present high property values and multi-layered project structures, whereas suburban markets in states like Texas and North Carolina emphasize stable rental opportunities. By exploring these regional variations, investors and businesses gain educational insights into how local market dynamics influence operational approaches. This knowledge is crucial for anyone looking to study organized credit use across diverse U.S. property markets. Let's examine key considerations that distinguish markets, business operations across the country. Urban versus suburban dynamics. Urban centers tend to have more complex real estate operations due to dense construction, mixed-use developments, and higher property valuations. Suburban regions often prioritize long-term residential rental stability, lower development costs, and incremental project expansion. Understanding these trends allows to see where business credit might be used educationally to structure and organize multiple property projects responsibly across different market types. State-specific frameworks. Each U.S. state maintains unique processes for property registration, lending oversight, and transaction workflows. These variations helps learners understand how businesses adapt operationally and strategically when coordinating projects in multiple states. Recognizing these differences fosters a broader understanding of organized credit across nationwide real estate markets. Educational resources for further learning. Reliable public sources, real estate analytics platforms, and business learning tools provide additional educational material for understanding regional differences. Studying these resources encourages an organized approach to managing multiple deals while emphasizing professional research and strategic planning. Recognizing U.S.-specific considerations highlights the diverse conditions under which businesses may organize multiple real estate projects using business credit. Differences between urban and suburban markets, along with state-specific frameworks, underscore the importance of understanding general operational strategies. By using educational resources and studying market trends, investors gain a comprehensive view of organized credit utilization across America. We explored how business credit functions, how U.S. real estate deals differ, and how structured funding concepts intersect with organized company finance. Remember, these points are for general educational understanding, not personal advice. To deepen your knowledge, explore reputable business learning resources and public data from national property associations. Stay curious, stay informed, and continue building your understanding of U.S. real estate financing dynamics. For more educational insights on responsible funding and market growth, subscribe to Real Estate Capital and Growth USA to stay updated on our next videos. Remember, this content is purely educational and aims to explain general concepts. Nothing shared here should be considered financial or legal advice. Thank you for watching.